taxes are such an important factor, probably the biggest expense any individual or business has. Depreciation is a borrowed term, right? We think of depreciation as something going down in value, whereas from a tax perspective, it's the name of a deduction that you get when you buy a piece of property, whether it's a commercial or residential, doesn't matter. As long as it's not your primary residence, any type of property, even if it's a business property, can take this deduction called depreciation. So it's based on the principle that things go down in value. However, it's not intrinsic to the property. And we have to always remember that depreciation is a borrowed term. Okay. So the main thing we take away from it is that it's starts the day you buy the property, and you have a schedule, you have a period of time that you can take, essentially write off the entire value of the property minus the land. Land itself does not depreciate, so there's always going to be a small amount subtracted from that purchase price. But essentially, you can write it off over a 27.5-year period as a residential property, including multifamily, or a 39-year period if it's any other type of commercial property, which both of them, it's a very long time to wait to kind of take those deductions. Cost segregation is the process of breaking down a property into its components, and certain components depreciate on faster rates than that 27.5, 39-year schedule. So for example, furniture, fixtures, anything that is non-structural, including flooring, countertops, cabinets, fixtures, anything like that, window treatments, all of that actually depreciates on a 5-year schedule. And there are what's called land improvements, which depreciate on a 15-year schedule, including landscaping or pavement, concrete, etc. All of that is the process of cost segregation, is an engineering, kind of breaking down a property from an engineering perspective, showing what each one of those components costs within the total value of the property, and then allowing you to take those deductions at that faster rate. So it used to be called component depreciation, which makes a lot more sense.
Sure does.
Right? Cost segregation, we're segregating the cost of that purchase, and we are allowing you to, essentially the IRS is allowing you to take those deductions at a faster rate.
Hi, Adam Gower here, founder of gowercrowd.com and host of the Real Estate Reality Show at youtube.com/gowercrowd and on all major podcast channels. My guest today is a repeat visitor and good friend, Yonah Weiss, who is a world expert, if not the world expert in cost segregation. My conversation with him is part of a series that I am conducting, examining the tax benefits of investing in commercial real estate, both for sponsors and real estate investors, passive investors. What we're going to drill down on, for the first time, shame on me really for waiting all this time to dive into Yonah's expertise. We've talked about LinkedIn and all kinds of other things before, but our focus today is on the skill, I was going to say the art of cost segregation. It's not really an art, it really is a mathematical skill. Yonah, like I said, is one of the experts, and you're going to learn about how that can assist in tax mitigation, tax deferral, how it's used, how it works, and what Yonah does for sponsors and for investors alike in today's episode. If you want to know more about Yonah and get some links to his website and his LinkedIn profile, just go to the podcast page at gowercrowd.com. And while you're there, do be sure to sign up for our weekly newsletter. We cover all the latest updates in the world of commercial real estate, syndication and finance. Goes out, like I say, once a week. You can always unsubscribe. There's all kinds of educational content there that we try to push out as well. And would love to have you part of that. In fact, if you go to the subscribe page, you'll see who some of the subscribers are. Actually, you see their companies. Quite an impressive list. Impressed me when I put it together. So you see that you will be in good company. All right, enough of that. My guest today, Yonah Weiss, cost segregation expert. Here he is. Yonah, as always, really, it's a huge pleasure to see you again. You've been on the show so many times, I'm thinking maybe I should issue you with a season ticket.
Hey, maybe get co-host, bring it on.
Well, that would be a good idea too. But today, what I wanted to do is to really explore a topic that nobody really likes, but that actually is probably the most important when you're considering commercial real estate investing. That is the tax benefits, tax implications of doing that. So what I'd like to do is to start at, as I said, as at a 101 level and then really dive deep. You are the world expert in this field, at least in certain aspects of it. We'll discover what others. I hope I don't stump you with daft questions later. But let's start at a high level. Let's start with the idea of depreciation. What is depreciation when you buy an asset? Actually, let's talk about it from the perspective of a passive investor, right? So it's the person we're talking to, somebody who passively invests in a real estate deal. What is depreciation? How does that help them?
Right. So you're absolutely right that, taxes are such an important factor, probably the biggest expense any individual or business has. Depreciation is a borrowed term, right? We think of depreciation as something going down in value, whereas from a tax perspective, it's the name of a deduction that you get when you buy a piece of property, whether it's a commercial or residential, doesn't matter. As long as it's not your primary residence, any type of property, even if it's a business property, can take this deduction called depreciation. So it's based on the principle that things go down in value. However, it's not intrinsic to the property. And we have to always remember that depreciation is a borrowed term. Okay. So the main thing we take away from it is that it's starts the day you buy the property, and you have a schedule, you have a period of time that you can take, essentially write off the entire value of the property minus the land. Land itself does not depreciate, so there's always going to be a small amount subtracted from that purchase price. But essentially, you can write it off over a 27.5-year period as a residential property, including multifamily, or a 39-year period if it's any other type of commercial property, which both of them, it's a very long time to wait to kind of take those deductions. But essentially, that's what we're doing. The IRS allows you to literally write off the value.
Okay, so let me again just really dumb this down. So what that means is, let's say we buy a property for $1 million, and it is a commercial property, so it's got a 39-year depreciation.
Right.
So what that means is that we get, I really do want to use some specific terms.
Sure.
So that means that we would get a K1 as an investor for the year that we made the investment, that would take that $1 million, divide it by 39, and deliver a tax loss that I can offset against passive income. So if that thing is generating rents, those are passive. That's also a tax term. You can clarify that as well, right? So it's passive income, comes to me as a passive income. The loss can offset that, so I don't pay as much or any tax on those income, that rental incomes, correct? Can you just kind of...
That is correct. Yeah, absolutely. And the amazing thing is that the passive income, you're right, is considered real estate or rental income. Applies if you have one property or you have 100 properties. They're all lumped together in one bucket, which means that you can use these depreciation losses from one property to offset the gain or the income from other passive income as well. So that's the power of real estate, especially when it's used as, not just a one-off kind of thing, but as an investment strategy, scaling and buying, multiple property, investing in multiple deals where you can get the tax benefits from one and use that to help offset the income from the others.
All right, so I'm going to ask you a couple of other questions that directly relate, and then let's dive into cost seg and how that works. You've made the distinction between residential and commercial. And some people mistakenly assume that multi-family real estate being residential is residential. It isn't. Can you give me the precise definition of what you mean? What is the distinction between, in terms of depreciation, commercial and residential, especially if you cannot deduct your primary residence, which really is the only residential property you might own?
Right. So the IRS defines residential property from depreciation perspective on a 27.5-year schedule as any place where people permanently live. So that would include multifamily on the residential 27.5-year schedule, even though from a lending perspective or from other, essentially it's a commercial property. It's producing income, and you can get loans as a commercial loan, et cetera. However, it doesn't take the same definition as 1 unit to 4 units in residential and anything above that commercial from a lending perspective. However, there are a couple minor differences with, for example, short-term rentals, where it's
Right.
essentially you have a house, you have a single family, and you're
Mhm.
renting it out. One might think that that's a residential property, whereas from depreciation, it's considered commercial, similar to a hotel, if the average stay is less than 30 days. So anything above a 30-day stay, so if it's a midterm rental, et cetera, that would still be considered residential for 27 and a half year. And then the commercial, again, is anything less than that, including short-term rentals.
Okay, so let's weave some details into this. I remember an accountant once telling me, told me about some kind of deduction that I had. I forget what it was. He says, yes, but he said, what the IRS giveth, the IRS taketh away. This is going to come up a little bit later. So the idea of depreciation sounds great today. What are the long-term implications of that if you buy a property and you do depreciate it? And we'll get into accelerated and cost seg in a minute. But what are the implications as far as the full life cycle of that property?
Sure. Well, I wouldn't go so far as that accountant characterized it, that they give it, they take it away. But there is something, anytime you sell a property, you are going to be subject to a special tax, besides for the capital gain tax, which is if you make a profit on the sale, you're going to be subject to that tax on. However, there's something called depreciation recapture tax, which is an unrealized gain. Essentially, yes, you've taken these deductions during the life of ownership. Now you're going to be taxed on the amount of those deductions taken. So your basis, the amount that you can depreciate, has been lowered over time. And then you're going to essentially, it's considered an unrealized gain where you're going to be paying or subject to that tax. And I make that distinction. Being subject to a tax is not the same as paying the tax. And so that's why I don't like that characterization, because part of the strategy of real estate investing is figuring out how many deductions I can get, how many things I can, how can I defer taxes to a later period? And there are many strategies within that that allow you to do both. And we can talk about some of those later: 1031 exchanges, opportunity zones, but especially when it comes to cost segregation, where we're taking larger deductions during the earlier years, that is going to incur a larger tax bill on the sale. And so you need to plan accordingly.
Right, and the term of art there, well, actually not the term of art, but the tax term is basis, isn't it? So let's use this $1 million example. So if I buy a property for $1 million and I sell it for $1.5 million, let's say, for argument's sake, let's say 15 years later, or what is it, 14 and a half years later. So I've depreciated it by 50%. I'm not looking at capital gains of 500,000. I would have actually depreciated the assets, and my basis would be 500. So the capital gains I'd be paying would be on $1 million, correct?
Uh, Sort of, yes. I mean, there are different calculations there, but essentially, yeah, that's what it comes down to. There's
You
going
look
to
at
be a tax on the gain from the sale, as well as on the recapture of that, whatever the 500,000 that was taken. And those are taxed again at different rates. Some part of that is actually taxed at the what's similar to capital gain rate, which is capped at 25%. And then another portion of that depreciation can actually be taxed at ordinary income tax rates.
oh, can be higher. So depreciation recapture is taxed at income tax rates, which are
A
higher than
portion
capital.
of it. A portion of it, yeah. There's three. That's actually, it is a little bit common. There's actually three different rates in which depreciation recapture is calculated, depending on the certain types of assets. And this comes into play a lot when we're dealing with cost segregation and we're breaking out the property into different categories. Some of those things will be depreciated at a faster level. We'll talk about cost seg in a minute, and therefore are going to be taxed at a different rate.
That's interesting. So if we are depreciating an asset, just to summarize this, again, a 101 level,
Sure.
if we are going to depreciate an asset, what we're doing essentially is potentially swapping capital gains rate tax rates, sorry, capital gains tax rates for income tax rates. Is that right?
Not exactly. So just I'll break it down, make it pretty simple. All right. Depreciation is necessary. You have to take
Oh, you
depreciation.
do? You can't opt.
You
You have
cannot opt, correct. It is an obligatory deduction.
ah,
And even if you don't claim depreciation, when you sell a property, you still have to pay the recapture tax, which
ah.
means the IRS considers it as if you took the deduction, even if you didn't. So people mistakenly leave out that deduction, thinking, erroneously that, oh, I won't, take the deduction, I won't pay it back later. No, take the deduction, use as many deductions as you can during the life ownership, because the time value of money, number one, number two, the ability to reinvest that capital, and essentially anytime you can deduct and defer and pay, think about paying taxes late at a later date, just allows you to scale much faster.
Right. So 29 and a half years, wacky numbers, 39 years. What is cost segregation? How does it work?
Cost segregation is the process of breaking down a property into its components, and certain components depreciate on faster rates than that 27.5, 39-year schedule. So for example, furniture, fixtures, anything that is non-structural, including flooring, countertops, cabinets, fixtures, anything like that, window treatments, all of that actually depreciates on a 5-year schedule. And there are what's called land improvements, which depreciate on a 15-year schedule, including landscaping or pavement, concrete, etc. All of that is the process of cost segregation, is an engineering, kind of breaking down a property from an engineering perspective, showing what each one of those components costs within the total value of the property, and then allowing you to take those deductions at that faster rate. So it used to be called component depreciation, which makes a lot more sense.
Sure does.
Right? Cost segregation, we're segregating the cost of that purchase, and we are allowing you to, essentially the IRS is allowing you to take those deductions at a faster rate.
And so there are only two ways to there's only a 5-year and a 15-year. So that's it.
Those are the main ones. There are a couple other, there is what's called a 7-year schedule, but there's very few and far between, and only certain types of properties would have that. For example, an office building, there's some type of, cable wiring and things like that are on a 7-year schedule. But essentially we're dealing with, 5-year, which is considered personal or tangible property, and then the 15-year, which is land improvements. There's also, again, a couple other random things that would be on like a 10-year schedule, or 20-year schedule. But again, it's extremely rare, and so that's why usually you just kind of lump it into those two buckets.
5 and 15. And so just curious, because the big line items to me would be things like HVAC, right? The HVAC systems. What is that? Is that considered personal?
HVAC,
yeah.
Yeah, HVAC, depending on how it's installed and what type of HVAC system, would determine whether it's considered structural and on a 39-year schedule, or considered personal property and on a 5-year schedule. So if it's individual units, for example, in each unit, that would be considered 5-year property. But if it's one internal system, that would be considered structural and therefore on a 39-year schedule. So
And not 15?
Not 15. No, 15 is almost always exclusively land improvements. So land improvements is anything on top of the land. Again, landscaping, pavement, fencing, signage, storm water systems, retaining walls, all these type of things. Anything that's on top of the land has a lot of value, significant, especially when you're larger commercial properties, retail properties, for example, large parking lot. That's a lot of value.
It sounds extremely complicated to do this. So let's say you get a client.
Not as complicated as your whiteboard behind you. I mean,
well, this is just, this is to kind of, this is a bluff, the whole thing. I like to tell people, but you can buy whiteboards pre-filled out on Amazon. You just tell them, I want rocket science or brain surgery or something. They send you, it's pre-constructed that way. So, all right. So how do you set about doing that? Because how do you do that as a professional? So cross segregator.
Yeah, there's a very detailed process. The IRS has something called the Cost Segregation Audit Techniques Guide. So it's this 300-page guide essentially showing you what needs to be involved in doing it. Like I said earlier, it's an engineering process, so it does require someone who has experience in construction engineering and understanding the tax code, which has extremely detailed breaking down each and every component and asset of what the lifespan is, and then creating a report similar to an appraisal, where it's literally breaking down every component, the line item, creating those calculations. And the calculations are quite complicated because it doesn't just take into effect what you would think the value of the property or those individual components are. For example, if you're building a property, you know exactly right? What the line items are, what, how much the windows cost there to install in this property, how much the pavement, the concrete, the parking lot is. However, when you buy a property for $1 million and it has everything in it already, now you need to figure out, if I were to reverse engineer and reconstruct this property, now I need to take all those individual components, what their useful life is, and what the remaining useful life of all those things are, and then come to a calculation of what the value based on the purchase price of all those individual components are. So there's a lot of calculus involved there, figuring out what the value of every individual component is.
So you have to get to know a building in extreme detail. All right. How do you do that? I mean, if somebody comes to you with a 100-unit apartment building that they bought, is it a copy and paste function that all apartment buildings are the same, or do you need to understand how have they installed the HVACs or what? Like, how do you do that?
Yeah, so we're looking on it. Again, we have our engineers that are qualified, that understand the breakdown of the properties. They are going to visit the property, take pictures, videos, measurements, and very detailed process of documenting everything that's in there, literally to every nail and every carpet, square footage of the property. So yeah, the one aspect with multifamily that does allow for the copy and paste function is within the property itself, meaning we don't need to go into every individual unit. We just need to go into every one of every layout. So if you have, a 100-unit property and there's 5 different layouts, for example, you need to see each one of those, and then we could copy and paste the findings from those within that individual property. We need to see all common areas as well, which is different from, let's say, a retail space or an office building where each suite and each unit is entirely different. That's much more time consuming from the engineering's perspective.
That's interesting because all the TIs are different.
Correct.
And have different values depending on how much they were when they went in. How do you guys price these reports, actually? Like, what is your cost schedule? How does that work?
So it's based on the scope of work of the project. It's a flat fee, so it's never going to be contingent on tax savings. The IRS does not allow for that. It doesn't make sense, right? You're saying, oh yeah, I'm going to tell you can save $1 million and now pay me 10% of that, right? It's a little bit fishy. So again, it is a flat fee. Typically, on average, somewhere between around $5,000 to $10,000, depending again on the size and scope of the work of the property, is usually what it's going to cost.
Really? Even though you send people out and engineers, I mean, it sounds like a huge lift to me to do that. It's kind of like
it is, it certainly is, but that that's part of the process, and the benefit is really there. It speaks for itself. Meaning, if you have a $1 million property, even to be honest, even a $200,000 property, people often ask, well, what's the kind of the limit of where it starts to begin the benefits? Even at a $200,000, single family, you may have enough benefit there that the price, the cost of getting it done is, doesn't even compare to the tax after tax benefits you'll get from it.
How long does it take to do a cost seg study, Yonah?
It could take just a matter of days. I think on average, I'd say it takes us about 2 to 3 weeks. We like to say it takes about 4 to 6 weeks, just so that we have the biggest volume of any company in the country. So we're doing 6,000-7,000 of these a year, which means we have a full team committed to making sure it goes through all the processes. There's a whole operations team checking and double checking and reviewing, a whole team of accountants that are reviewing everything as well. So it does take time. Like I said, it could just take a matter of days or a week or so, but because of the whole process, we like to give a little more buffer.
Right. Yes, you made one interesting comment here. I'm just going to come back to this.
Only one. I thought, we've been trying our best.
One interesting one that I haven't yet asked more about, but I should clarify there. I am trying to follow up on everything. I just don't want to let anything fall through the gaps. Right. So these might be a little bit out of order now, so just forgive me for that. But what are the so all kinds of different real estate asset classes? There's office, data centers, multifamily, medical office, whatever. There's a million different self-storage, industrial, etc. So if you were to line up those that benefit from cost seg studies the most to the least, without going through every single asset class, what would that like? What are the best and what are the worst asset classes?
The number one best, with like hands down, are car washes, because there's a specific rule the IRS gave with car washes that they depreciate on a 15-year schedule, which means that there's no structure. There's no 39-year, which means there's what we're breaking down is the 5-year and 15-year within that whole property, which basically, except for land, you can depreciate the entire amount on a faster schedule. And with bonus depreciation, which allows you to take that in a lump sum in the first year, 100% of that, or right now 80% of that, it may be coming back. There's a bill in Congress right now to bring it back to 100%. But car washes, hands down, the highest amount. I'll go skip to the low end for a second, and we'll come back to the high end just to give you a little perspective. Industrial properties, for example, are kind of on the lower end, where you're not usually going to have a lot of personal property in there. You may have land improvements, some landscaping or some pavement, etc. But essentially, the main building is the structure. Now, remember, the structural components, which every property has, including the doors, windows, roof, walls, foundation, right? Any interior drywall or anything like that, infrastructure, including water, electric, plumbing, etc. All of that is structural on a 39 or 27.5-year schedule. So in industrial properties, we're looking at maybe 5 to 10% of the property value can be in those accelerated depreciation categories. So again, from 100% down to 5 or 10%, that's a huge difference. On the higher end, we'll go back to the higher end. The next level down are RV parks and mobile home parks, because there are usually no or little structure involved. And what we do have is land improvements. And the majority of the property, and you can think about golf courses as well, the same thing. The majority is land improvements, the landscaping, the pavement. A mobile home park, you have roads, you have concrete pads under each home. And in many cases, they are tenant-owned homes, which means you don't actually, as the owner of the mobile home park, don't actually own any of the homes themselves, which means all you have is the land, again, which does not depreciate, and the land improvements, which are the landscaping, the pavement, the concrete pads, etc. And so that is a huge amount, oftentimes up to 80% of the property value going into those faster 15-year land improvements. When we'll kind of go down the scale, the next higher thing is probably, I'd say, manufacturing facilities can sometimes get up to like 50% of the value because of the extensive equipment and machinery. And then on average, just the average, we're looking at about 25 to 30%, or many other type of asset classes. So looking at multifamily, self-storage, retail, office buildings are a little on the lower end, but all of those would, on average, have about 25 to 30% of the value in those faster depreciation categories. So again, remember the 5-year property, including furniture, fixtures, appliance equipment, and then the 15-year, which is the land improvements. So that's in a nutshell. And there are, as you mentioned, every type of asset class can fit in there somewhere on the spectrum. And we're not going to get to every single one, but that's on average what we're looking at.
Right. So bonus depreciation. This is something slightly different, isn't it? This is another layer on top of the depreciation ideas that we've been talking about. Can you talk about that as well, please? Bonus depreciation. It's also called accelerated, isn't it? Is that the same thing?
There are a lot of different terms. I mean, accelerated depreciation technically just means putting the depreciation on a faster schedule than the 39-year. So consideration can also be called accelerated depreciation. The 5-year and 15-year schedules are accelerated.
Okay.
There's also another, kind of even more complicated tax term, which is called, 200 declining balance or double declining balance, which allows you to take some of the, even on the 27.5 or 39-year schedule, you can opt to take a little bit more upfront in the first few years and get a little bit on a faster schedule. So that's also considered accelerated depreciation. Not getting too much into that, into the weeds, but bonus depreciation was a law that was introduced, and it's actually been around in many forms for many years, but back in 2017 with the big tax reform, the Tax Cuts and Jobs Act, introduced something called 100% bonus depreciation, which never existed before, and allowed, once you've done a cost segregation study and have allocated accelerated depreciation to the 5-year, 15-year schedules, you now had the option to take 100% of those deductions in the first year.
The 5-year deductions.
The 5-year deductions,
Just
the
the
15-year
5-year.
deductions, correct.
Sorry?
5 and 15, anything less. Correct. Anything less than 20-year depreciation allows you to take 100% of those deductions in the first year.
So what would that,
was,
sorry.
And it was huge. It was huge. So I would just take a simple example. We gave your $1 million property at the very beginning, where you're talking about dividing that by 39 years after taking a land allocation. That's about, a $21,000 deduction every single year, right? If you spread it out over a 39-year period, that's regular depreciation. Cost segregation, let's say you're going to get 25% as accelerated in the 5-year and 15-year category. That means, $250,000 in the first 5 years, right?
Yeah.
Of the $1 million property.
Oh, I
but
see.
you're spreading that over, right? That's about $50,000 a year, as opposed to the $21,000, which is great, right? Which is in the first 5 years, you're getting a double, more than double of your deduction.
Mhm.
Bonus depreciation says you can take that lump sum $250,000 deduction in the first year as a tax write-off. So you bought a $1 million property. It doesn't matter how much money you put down, right? It doesn't matter.
Right.
Yeah, it doesn't matter if it was seller financed and you literally didn't put a single dollar down. You're able to take this $250,000 deduction. Now, as we mentioned earlier, there are limitations, right? It can only offset passive income unless there's a few exceptions to that. Notably, if you are a real estate professional, you or your spouse are allowed to take those deductions against active income or W-2 income as well. Otherwise, most people, especially passive investors, would be limited to use those deductions just to offset any passive income.
Yeah, we're going to talk about real estate professional status in a different podcast. It is extremely complicated and not easy to get. I've been reading a lot about it. But staying on cost seg right now, one of the things kind of now moving on to this one comment that I haven't commented on that you said that was very interesting, the only one I've not commented on yet. Quote, subject to a tax, but not paying it. And then you segued into 1031 exchanges. Can you talk about that concept, subject to tax, but not paying it?
Absolutely. And I'm glad you clarified that, brought that back up, because it's such a powerful concept. When we're dealing with taxes, we want to be looking for as many deductions as possible. And if we can't find deductions, what can we defer? Right. So there are many different strategies that can employ both of these techniques of both deferring and deducting. Being subject to a tax, meaning if you make, $1 million and you're at a, whatever, 35% tax rate, that means you're going to be subject to a $350,000 tax. Simple numbers. Now, then we're going to look at deductions. Okay. So we're going to have child tax credits, for example, you'll have business deductions, you'll have all kinds of things. So then we're going to reduce that tax liability more and more and more and more and more. You add in depreciation. If you own commercial properties, again, you may have other deductions like the mortgage expense, taxes, insurance. All these deductions are going to reduce that taxable income more and more. So again, we're talking about being subject to this $350,000 tax. After all is said and done, we may not actually have any tax liability whatsoever with all of these deductions. And so that works with the depreciation recapture tax as well. You're going to be subject to this. When you sell a property, it's going to, bring up this big tax bill. Now, what other deductions can we have? Because the great thing about cost seg and about these extra losses you may get, you may not actually have use for all of those losses in the current year. If you only made $100,000, let's say, for example, and you get a $250,000 deduction, well, guess what? You have an extra $150,000 of losses that really just stay. You don't lose them. They stay on your tax return as like an imaginary bank account, essentially, allowing you to use them in future years. Not only to use them in future years to offset passive income, but, and this is the great part, to use it to offset the gain from the sale of the property. Meaning you can actually use the losses from cost segregation to offset the recapture tax from the sale of another property or even the same property. So again, you're going to have, that's why I don't like the idea of, you're taking the deduction, you're going to have to pay it back when you sell. No, you may actually strategically buy one property and have enough losses from using the cost seg to offset the gain from the sale of another property without the 1031 exchange, without deferring anything, literally wiping it out.
That's interesting. I would love to look at some actual kind of scenarios and case studies. That's a whole different discussion, though. But there is something that I read actually actually, let me see if you can answer this. I hope you don't mind my asking, but let's say we've got this $1 million property. We depreciated it by 50% for however we did that. Now we sell it for $1.5 million, so we've got $1 million profit. What would be the size of another asset that we would have to buy to offset that whole $1 million? It's not like I'd go out and buy another $1 million property. It wouldn't be enough, would it? But if I bought a $3 million or $4 million, like just ballpark, what do those scales look like?
Yeah, so you always have to look at, again, the type of property, the amount of cost seg that you can get, the bonus depreciation, for example. In our example, we talked about on average a multifamily property, about 25% of that we'd be getting as accelerated depreciation,
Okay.
and take into account the 100% bonus depreciation, which was around between 2018 and 2022 and maybe coming back. The amount you'd need to get, you're talking about a $4 million or $5 million property after taking off land, that you'd be able to get that $1 million write-off.
Right. And here's I just read this that you cannot do. So if I do a 1031 exchange with that, so actually, why don't you tell a 1031 exchange? Let's start with that 1031 exchange.
What's a 1031 exchange?
Yeah.
Yeah, a 1031 exchange, and that's the name of the section of the tax code, right? Section 1031 allows you to sell a property without paying capital gain tax by exchanging it, so to speak, for buying another property in its place. Now, you're not literally exchanging it. You're not like saying to the seller of the other property, "Here, take my property and I'll take yours." That's not what it is. It's just filing specific forms, and there's certain timelines that you need to abide by that allow you to put in escrow the property within the time frame that you're selling it, and then buying the other one. And by doing all that, again, filling out the proper forms, abiding by the certain timelines the IRS gives, you're allowed to defer any capital gain and any depreciation recapture tax that would come with the sale of a property. So that's the 1031 exchange model. By doing that, and now you had a question about combining that with using a cost segregation.
Yeah. Yeah. So the question was, so let's say I sell my building for $1.5 million, and I do a 1031 exchange. So I go and buy another $1.5 million building, and I get another 20 or a $4 million building, and I get 25%. So I've got $1 million of losses. I cannot add that to that. That defeats the 1031, doesn't it? It actually triggers. So how does that work? If I attempt to offset the gain, I'm like losing my line from. You know where I'm going with that.
I know where you're going with it. Let me try to
Please unravel it for me. Yeah.
Yeah, the question. So you sell a property.
Let's try and help me with the question first. Then we'll get to the answer.
You sell a property with a 1031 exchange, which you've already depreciated significantly. Whenever you do a 1031 exchange, even before we get to the cost seg, your basis carries over, okay? Which means you don't get to start fresh, brand new, a new tax basis to depreciate on a new property. Whereas if you buy a random property, right, without a 1031, you get to, again, remember at the very beginning, we talked about depreciation being a borrowed term and not intrinsic to the actual property. It doesn't matter the property was built in 1925. You get to start depreciating this 27.5, 39-year schedule from the day that you buy it based on your purchase price. And that starts fresh every time there's a new owner. So it doesn't matter if you bought it for $1 million, sold it for $5 million, the new owner gets to start depreciating $5 million. However, when you do a 1031 exchange, you don't start fresh the schedule. Your basis carries over from the previous property. So if you had already taken $500,000 and only $500,000 is left, so when you buy a new property, you're only taking over a $500,000 basis that you can
even if I spend $4 million on that new property.
No. So that's the big difference. Is any new capital that's put into the new property can now be depreciated as well.
New capital including debt?
Including debt, yes. Which is incredible, right? So you sell your $1 million property, $1.5 million property, and you scale up and you get a loan for 75% loan to value, whatever, and you're able to buy a $5 million property. I know the math is not perfect, but you now, instead of starting your depreciation basis at $5 million, right, like any other property you would buy, because you did a 1031 and you had only a $500,000 basis, you have to subtract that 500,000 from, or right from that gain that you had, that unrealized gain from the $5 million new property. So again, you're carrying over your basis and you're essentially subtracting that from whatever the new value of the property is.
Which would mean that I could now depreciate 4.5 million. But what I
Correct.
read was as soon as I try to do that in a 1031, it triggers repayment of those deferred taxes. No?
Not that I'm aware of, no.
Okay, so 4.5 million, I can take the 4.5 million and start depreciating that in this example.
Correct.
All right. We've not got that much time. Gosh, look at that. It goes so fast. I just have a few more questions, if you don't mind, Yonah, just to drill
Absolutely.
down on here. Right. So you do a cost seg study and everything that we've just talked about. By the way, thank you for the introductions. I'm going to preempt the answer to this a little bit, but on LinkedIn, you've made some nice introductions over here. If you provide a cost seg study to a CPA who is not familiar with commercial real estate, will they know what to do with it?
I hope so, but you can't really put hope in when you're dealing with taxes. It's best to have that conversation beforehand. Okay. It's best to speak with your CPA if they understand it. And unfortunately, I've come across way too many CPAs that don't understand it. Now, that shouldn't be the case because this is something that's directly in the tax code. It's not some like kind of, crazy outside strategy. However, there are many CPAs that are just not familiar with real estate enough to understand how this works. Not only to understand how it works, but then how to apply it and how to apply it against what type of income. Again, depending if you're a real estate professional or not, that is also a very big consideration. So again, preempt it by having that conversation beforehand with your CPA if they have no idea what it's talking about, or even worse, they say it's some sort of scam or something like that, which I've literally had come. Find a new one, go do your due diligence and try to find someone who does understand real estate.
Yeah, it's not just the after the fact. It's also in terms of tax planning.
Yeah.
Like, what do I do this year? How do I, it's going forward. You've got to plan for tax. You can't do it retroactively. Once January the 1st comes around, it's too late. You got to plan. So that's important. So two final questions. One, so what kind of mistakes do people make with depreciation, cost seg, planning, whatever, in the whole scheme of this conversation? What are the mistakes that people make that are avoidable?
Big mistakes are not planning accordingly, right? Big mistakes are, again, not having that tax. We talked about that briefly. Another mistake that is just people don't know about, there is an issue when you're dealing with a renovation of a property. Now, anytime, like we said, your property is the depreciation is based on the purchase price. That doesn't change if it gets an appraisal and now is worth more. The only time the depreciation changes is if you add more capital into the property. So for example, you're doing major renovations, you're adding money in. However, based on the timing of when the renovations happen may affect how much of that you can actually depreciate and whether you can even do a cost segregation on the original property or if you have to wait until after the renovations are done. Again, there is timing involved there. It's best just to keep it simple. It's best to do the cost seg on an acquisition of a property. Wait to do any renovations, rent it out, make it be placed in service for a certain period of time. So you're able to capture all of those cost segregation deductions and then do the renovations, write off anything you're going to throw out. And then what you're replacing, you can now depreciate fresh all of those new improvements.
Do you guys advise on this as part of your engagement? I mean, like if somebody is planning to is planning for the year, but doesn't have a building that they bought yet, so they can't engage you to do a cost seg. How do you work with potential clients who are making plans for the year ahead and advise them on, all right, you buy this, don't do that, do this, don't do this, here's what you should be doing, etc.
Yeah, I'm happy to advise. It is part of our service. I actually provide free consultations for anyone. You can check out my website to find how to book one of those and just to discuss what the options are and see, because the biggest thing about cost segregation in general, whether the planning or whatever, is education. Most people don't do cost segregation simply because they don't know what it is. or they don't know enough about it, or don't know how it applies to them. So educating yourself is the most important part of the process.
My last question. How on earth did you get into this business? I mean, like you're obviously passionate about it. But it wasn't something at at high school you thought, oh, Mom, I think I want to be a cost segregation.
I want to be a cost segregation expert when I grow up,
How did you figure that out? How did you stumble into it? What is it about it that you love so much?
I think, I'll answer the second part first. The thing that I love about it is I'm literally just helping people all day long. And also, what I've found, surprisingly, is that when you help people save $1 million in taxes, they like you a lot. So I have a lot of friends, I've made a lot of friends through this. And I think that's actually an important part of it. But, I was involved in real estate. I was actually a teacher for many years and spent, close to 2 decades teaching. That's really my passion and still is what I do today for the most part. And, I got involved in real estate about 8 years ago and really kind of stumbled from one thing to another until I was introduced to this company, Madison SPECS, where I currently work, and biggest national costing company. I didn't know what it was, but to my surprise, neither did anyone else that I spoke to. So, I reached out to everyone that I knew in the real estate world after having, been networking and being involved in the space for a couple of years. And literally almost nobody knew what it was. But I did have one mentor, a person who I'm still close to this day, who had been in real estate space, commercial real estate for probably 35 years. By now, started off as a broker and then became a developer. He develops very high-end industrial logistics properties, $1 million, a million square foot, logistical properties. Really incredible person. And I spoke to him. I said, hey, about this cost seg, I'm thinking about working for this company, Madison. He's like, oh yeah, I use Madison for all my cost segregation. So I was like, okay, so this guy gets it. He's extremely successful and he uses this company and likes them. So that was a good sign for me. But yeah, literally just stumbled upon it. Didn't know much about it, but because of my kind of teaching background, able to pick up these concepts very quickly. Had the experts that who run the company, who've been doing this for decades, that really I learned everything from, and I'm really grateful for that opportunity.
Right, let's sign off. Let me just have a quick look. Yes, so I was going to say, how do people reach you? But I'm going to tell them how to reach you. Yonah is highly visible on LinkedIn. Yonah Weiss, Weiss. Go to his profile. And if you go to the contact button there, he's one of the few people like me who actually includes his email address and phone number, apparently. It's everything. But is there any other way that other than LinkedIn that you'd like somebody to reach out to you and learn more?
Yeah, I mean, you can go to yonahweiss.com. You can also check me out on any other social media platforms if you're active on there. I am too. But I do just want to say one thing about that. Take 10 seconds and write a little message, right? It doesn't take longer than that you heard us on on this podcast discussing that, because it's very easy to just kind of hit the follow button and then, that's it. But I really enjoy the conversations and meeting new people. And I think it's really important. So yeah, let me know. And I think Adam would like to know as well. Right, who's listening to this podcast, who's reaching out to the guests, and who's finding value.
Yeah, I'll make sure that our listener today contacts you.
All one of them.
But yeah, Yonah Weiss, Madison SPECS. I was just looking at that, make sure I got it right. Thank you so much for joining me on the podcast today.
Been a pleasure. Thank you.
All right, that was Yonah Weiss, cost segregation expert and good friend. I hope you learned a lot. I'm sure you did. I certainly learned a lot about it from Yonah. Of course, if you want to know more about it, do feel free to reach out to him directly. You can find his contact information at the podcast page or on the podcast page at gowercrowd.com. While you're there, do be sure to subscribe to our newsletter. It goes out once a week. You can always unsubscribe. It's totally free. Covers the world of real estate investments and finance and syndication. And it's a good synopsis of everything that's happening or has happened over the last week, with some analysis and some educational content there as well. That's it. Yonah, thanks for joining me. Such a pleasure. And thank you for your patience in waiting for me to actually ask you about your primary skill set and not dwelling on your expertise on LinkedIn and Twitter, but to focus on cost segregation. And thank you also, dear viewers, I hope, for having joined us today. Hope you found the conversation of interest. We will be publishing probably some detailed analysis of the tax benefits of investing in real estate. So another good reason to subscribe to our newsletter. That is where we will announce it there at gowercrowd.com. Just hit the big subscribe button that you see there. Again, thanks so much for joining me. Until next time, this is Adam Gower signing off.